Hey, I hope you're doing well. Today I'll be taking a look at Uber. Just as a disclosure, I do own a sizable position in this one. It is in the single digits as a percentage of total portfolio, actually, total wealth of mine. So it is a sizable position, and yeah, let's proceed. As you can see, I have a line over here, the red one, at 81.48. This is the short-term cap on this one. As you can see, it bounced 3 times on this one. So this, there's some momentum upwards. As you can see, I'm not a technical analyst. I don't know much about this, but this looks like a pretty strong resistance at 81.48. But let's talk about the fundamentals, because this one is not a short-term or even a momentum trade for me. This one is primarily I would say a margin and steady growth story for the long term, specifically for me. I'll tell you more about it. Let's take a look at their fundamentals here. As you can see, the growth has been pretty steady, but it has recently got a pretty good valuation. So the valuation has decreased. So what happened? Specifically, they went profitable, as can be seen here. As could be seen, the free cash flow has improved from negative 3.36 billion, which they lost in 2020. And in 2024, they raised it to 7 billion. As you can see, the growth here in free cash flow has been very strong, as well as the EPS, which let's take a look at the annual. The EPS has improved significantly. And I wanted to take a look at their valuation at the same time, which, has been expensive, as can be seen here, where they weren't even profitable. So the PE was pretty expensive. Well, they had a 0 PE. Well, didn't even have a PE because no earnings, obviously. And now in 2024, well, it's 2025. I'll take a look at the specifics a bit later, but for now, a 13 PE and a price to sales of 2.95. This is looking in the past a little bit, so let's bring it up a little bit. I don't think this is too accurate, so let me get some better numbers for you. These are projections, so it would be next year, 23 PE for next year. This is accounting for 14.45% year-over-year sales growth and a 36.75% improvement in EPS. And I want to take a look at why, or at least where, the growth is coming from to better explain the business to you. And actually, before I elaborate on these numbers, I want to explain what Uber does. Uber operates in 4 segments: mobility, delivery, freight, and I'm pretty sure other, but I don't know exactly what that is. I can't remember off the top of my head, but let's talk about mobility. Mobility is the one, and actually the primary business that they operate in. Most people know this, but I'll still explain it. There's an app on your phone, Uber. You can order basically like a taxi, and it gets you from point A to B, just as a taxi would. And then there's delivery, which is the delivery of goods from point A to B. That one is pretty simple. Freight is the new one, or at least people wouldn't really consider Uber with connection to freight. But freight is I wouldn't say it's new or really growing business, but it is a part of, their revenue as a group of revenue. Freight is basically, they act as a contractor between parties that want to transport and parties that want something transported. As freight would be, kind of self-explanatory, and I believe that sums that up. As you could see, they were primarily in 2018 was their core business, which would be mobility, but this has grown with specifically delivery taking a chunk. But I want to take a look at the mobility growth, because this one is technically the higher margin of all of them. Delivery is known. I'm pretty sure delivery is the lower margin of all of them. So I wouldn't take that look at the delivery as much of a factor within a reason to buy Uber. I would take a look at mobility. As you can see, mobility has grown very strongly and has been at a good pace in general. But if we take a look at the components of, what countries or regions are driving this growth as between here and here and here and here, between these 3 years, and because I'm taking a look at 2022, 2023, and 2024, primarily because these are the years that Uber went profitable and is able to generate strong free cash flow, as could be seen. Sorry, let me get it right here. The free cash flow turned positive in 2022 when it went from 2021, where negative 743 million to positive 390 million, and has grown at a pretty strong pace, as you can see here, to 2024. The growth is obviously slowed down, but still pretty good. Doubled its free cash flow between 2023 and 2024. But we can take a look at the actual metrics within, and you can see what is growing between 2023 and 2024. And I'll actually give you a clue into what is going to be the plan for growth in the future years, specifically towards 2028, is as far as I am realistically willing to project. Past that point, who honestly knows? It wouldn't be wise for me to project past that point. As you can see, the growth has been primarily outside the US, but the US growth is still decent. I would actually expect this to slow down. The surprising part is the growth has actually a bit accelerated between these 3 years right here. But we can see that the strong growth has been, I'm pretty sure, yeah, the UK. They actually spoke about this on the earnings call. I'm not going to go find it. If you are interested, you could go visit their investor relations page and find their transcript and look it up. But it was primarily they are focusing on regions within the UK outside of London, like Liverpool and stuff like that. And so they're expanding within the UK, and they actually, just as a glimpse towards the forward years, they are, planning to grow a bit more into Latin America, which I'm pretty sure has pretty good growth. No, well, not really that good. But they are planning to grow stronger in Latin America and Europe. These are the primary regions they are expecting to gain revenue growth. They have stated that the United States is a bit more saturated, although, they're still cranking out some growth here. But I'm pretty sure this is primarily pricing growth and not associated with, is not associated with the amount of rides increasing. But the UK has been pretty strong grower here, and I would honestly expect Europe to be a strong revenue grower as well in the consecutive years. And they did mention this as well as the UK. UK has been, as you can see, pretty strong. That's enough on revenue and, forward project. Actually, let me show you some forward projections on sales. Analysts are predicting 14% consistent growth for several years forward until 2027. Honestly, I think 14% is a little high. I would honestly put it at around 12%. That would be more reasonable, 10 to 12%. I believe they can hit those metrics. Could they beat these numbers? Absolutely. Could they fall below these numbers as well? Yes. If there's, for example, a recession, that would be bad. But regardless, I'm not projecting a strong recession. Even if there is, honestly, I would not. It wouldn't be too bad for Uber. I think Uber could do fine. but that's a topic for another video, honestly. So let's move forward to margins. And as I have stated in the beginning, this is kind of a margin story as well as a revenue growth story. And let me show you some margins, because margins have improved and they've honestly been all over the place. As could be seen here, net income, net income margins look amazing. They do. But there's some accounting tricks going on here, as could be seen by this clue. Margins usually go down as, you add expenses, operating margins, then EBIT and EBITDA, and then net income. Net income should be the lowest margin of all. And yet, operating margins are 6.36%, and net income margins are 22.39%. Why is that? Okay, I'm gonna explain some account trickery here. And then I'll explain why not to use net income margins for Uber, because there's some accounting shenanigans here. I know these numbers look scary, but just keep up with me here for a little bit. The reason here we have pre-tax income. This would be your operating income associated with operations within the business. And as you could see here, there's a weird number that increases. This is provisions for income tax. I'm not going to explain why this happens or what it's associated with, but this basically increases their net income. And this is why I would advise you to avoid using net income. This is primarily because I'm pretty sure they reported higher income. Well, they paid higher income tax than they should have, and therefore, this counts as like a adjustment basically to income, and that's why their net income looks higher than it should. Let's move on. So as you can see, net income margins operating margins have improved significantly, as could be seen through the steady growth here. Avoid this number. Specifically look at these, because these are 3 consecutive years I was talking about where, they started churning out profit, and specifically this year they started getting cash flow. And operating margins have improved significantly, and I'm pretty sure operating margins have improved to 10% now, if they're around here. Yeah, I can't find that. Maybe not 10%. I'm pretty sure it is 10, but right now it's showing 6.36, which is fine. I believe this year we should get to 10%. In the recent quarter, it should have been 10%, but it's not here. Anyways, I believe it is 10%. Regardless, it doesn't matter that much. They're going to reach 10% anyways. And honestly, I'm projecting around mid-teen margins. They will achieve this by 2028, and with a pretty reasonable growth rate of 10 to 12%, and margins improving to mid-teens. This looks like a cash flow churning story, and this is one of the reasons why I find this such an interesting opportunity. Is the valuation is good, A. B, margins are improving, growth is strong, and therefore we can expect higher cash flows in the future. And if we take a look at the growth, if we project around the same growth and we take a look, expected about 57.65 billion in revenue for next year, and EPS being 3.32, that's a 23 PE. I would honestly expect higher cash flows as well associated with this. So if we expect about 14%, improvements to cash flow. Cash flow would be improving much more than actual revenue growth because margins are improving as in the same time that revenue growth is increasing. So I would honestly, I'm not going to project because I haven't done the cash flow projections, but if we associate about 7 billion in cash flow for next year, or honestly this year, which is not the correct projection to have because, it's growing, 7 billion of their market cap of 157, and they are planning on buying back about $7 billion dollars worth of shares. That is a nice reduction in the shares outstanding, which should boost share price as well as like the valuation looks good. So this is a very good story for as an all-around play here. I did want to show you some graphs to. Okay, why does this not have a title? Oh, that's so lame. Anyways, I'm pretty sure this is whatever. This is margins. Associate this with margins. As you can see here, I wanted to show you some improvements in operating leverage. And I'm going to explain a little bit what's going on and why margins are going to continue to grow. Just a couple things. Yes, gross margins have declined at the same time as operating margins have increased. So primarily why gross margins are decreasing. Well, if we take a look at, actually, I'm not going to show you, but if you look back, we talked about they're expanding more internationally. So everywhere except the US. So, and this implies that the margins across, well, not across the board, but margins are going to be, gross margins specifically, are going to be lower because of, they can pass off less of the cost to consumers outside of the US. And you would honestly expect this, which is fine, but their operating margins can stay high because they are operating in greater leverage within the markets that they are saturated in. For example, the US, as they have spoke about it, they are improving their monetization tactics within the US. For example, they're adding advertisements within drives at the same time as doing some algorithm optimization. For example, making you wait a little bit. I know that sucks. That ruins the product a little bit, but if you need the car ride faster, you will pay up. So you're basically paying with time or money. And in both cases, that is a benefit towards A, the drivers, and B, Uber, because they are able to increase prices or upgrade you to products with higher margins. So this will keep going on and actually improve in countries that are currently unsaturated. For example, the UK, which the UK will at some point turn saturated. And if, it's currently at 8 billion, we're probably going to get to 10 billion in the UK. And margins over there are going to improve once the market gets saturated. I don't know when that's going to happen. I don't work at Uber. I don't have the inner data over there. So I can just assume, maybe 2 to 3 years, maybe 4 years, once the, parts that are outside of London become saturated, which is fine. As you can see by this graph, how margins have improved. Yes, the growth has slowed down. Remove this TTM because this is for this year, but not finished year, so avoid this. As you can see, the margins have improved, but they're improving more steadily, as you would honestly expect. And gross margins and the revenue is strong. As you can see, the revenue growth here is super strong. In this case, avoid 2022, avoid 2021, because, it's a weird years, COVID, and all that stuff. And now, just to speak about particulars about the repurchase. This is a report from an analyst. I'm pretty sure it's Robert something. Mark. It's Mark. I don't know how to pronounce his last name, so I'm not going to. But people are worried about AVs, which are autonomous vehicles. For example, Waymo, kind of Tesla, not really Tesla. But the primary reason I'm not really worried about AVs, and honestly I see them as a benefit towards the company, is, and they've spoken about this on the earnings call as well, is that none of these companies, for example, Waymo, Tesla, they only have the product. So they have the supply, but they don't have the demand part, which is the platform, which is Uber. So all of these companies that are building the supply part of the equation here are not building the demand part, because they have to build out their own platforms to get consumers on those platforms, and it would just be inefficient to build their own platforms. And that's why companies like Waymo have partnered with Uber, for example, in Austin and Cali. And I'll just show you some activity here as it goes with, oh my God, they mentioned it 72 times. Yeah, here they have mentioned it, that it's going to take a long time to commercialize it. And I absolutely agree I absolutely agree with that. If any of you have Teslas or have tried out Teslas and their, self-driving feature, you'll know that it's wonderful when it works, and it is absolutely terrible when it doesn't. And it's more likely that it will be terrible. For example, the first time I've turned on the Tesla self-driving feature, it wanted to drive straight into a garbage can. It constantly did that. I don't have a video of that. I don't have it saved, but I'm kind of terrified to turn it on anywhere, because it just really wanted that garbage can. And anyways, whatever. This is not a video about Tesla. This is a video about Uber, and as they have stated, Uber will be indispensable with AV players. It absolutely will. They will be crucial to bringing all of these products to market, because Uber has the consumers. They have the demand side of the equation, and there's not many other companies. Honestly, there are very few companies that can match Uber. Uber is the fundamental player in the US, and this is primarily where AVs are going to first start rolling out massively. They haven't really stated when this full rollout they're expecting, but they actually did mention. They mentioned it would be in like 2030. They're expecting it to be 15% of 15% of total revenue or total rides. Oh yeah, right here. So I think in the next 5 years, the addressable market is going to be probably in order of 10 to 15% of the overall marketplace, and then gradually is going to expand over 15 years. Yeah, and they actually mentioned that AVs are able to be A, higher margin, B, people that have tried AVs for the first time prefer to use them consecutively to other riding choices they have on Uber. And thereby they are able to price it a bit more as a premium product, and thereby these are even higher margin products. So I would honestly see AVs as a massive benefit to Uber. So Uber will be a massive beneficiary of this AV technology. Even though they do not develop it directly, they own a very crucial part of the equation here, which is the demand side. And this is why I find Uber as a fundamentally mispriced opportunity in the market here. And with their higher apologies. Uber does, and with the repurchase program, I would expect this to be at least a 2xer within 2 to 3 years here, minimum. Next year, I wouldn't be surprised to see it at $100. But over that time, I would see maybe revenue acceleration or margin reacceleration, something here to boost the engagement within Uber. And I would also like to mention what the sentiment is. First of all, I'm going to mention what the sentiment was on the call, on the investor call in February. It was extremely positive. It was super enthusiastic about both the AV part of the business and their potential for growth outside of US. I'm not going to bring in specific quotes or anything. I'm just going to, if you're really interested, you can listen to it. But it was extremely positive. There was a ton of enthusiasm between the CFO and the CEO. So I would be extremely bullish just purely off that. And to mention, the CEO has been in the company since 2018, if that really matters to you. But I want to mention what the sentiment is around the stock, which the sentiment is kind of bullish, as could be seen with the oscillators and the moving averages, because it is above the moving averages here, as could be seen if we do this close up over here. So it is bullish in the short term, but this ceiling right here is a problem. I wouldn't be too worried if you're buying this as a long-term play. You could have better opportunities to buy maybe mid-year if there's some poor macro data. But regardless, if you're buying this as a 3, 4, maybe 5-year play, maybe even longer, this will be a big opportunity regardless of your entry point in this range. Additionally, I forgot to mention one more thing, and it was the financial health. In terms of if there's a recession or not, let's consider, for example, a recession. In that case, let's say cash flows decrease by 50%. In that case, they have sufficient capital to, weather the storm here. And still, even in that case, they still have positive cash flows. I think debt is in a reasonable position, and that's why they have held it pretty much the same as far as it goes. Well, actually, it's slightly declined, but honestly, that is quite irrelevant. But as you can see, their financial health is in a good position. Their short-term assets are higher than their liabilities, as well as long-term assets being higher than liabilities. I would honestly expect the bankruptcy of risk in this one is very limited. And I think that pretty much sums it up. This has been, I know, a lot, but this company is a lot, as obviously could be seen. And yeah, I'm pretty sure that's that. Thanks for watching. If you found this helpful, please like, share to anyone who might find this helpful, and subscribe. All right, have a good one.